Hello, I'm a day trader who specializes in basically trading the NASDAQ and the S&P E-mini stock index futures. And the reason I do that is because they're very good margin rates for day trading. And I used to trade the futures markets, the commodity futures, and would hold a position over several days. The same technique I found trading futures on a daily basis could be used to actually trade by the minute. So I've been making a series of fairly amateur videos showing what I believe to be the best technique I've ever found for trading. And I'm a bit biased, but you can't argue with what works, and this produces an income on a daily basis. And what you see here is a 1-minute chart of the NASDAQ E-mini stock index futures, and I'll just use this to show the technical analysis techniques. Basically, this is kind of a long video, so I thought I would divide it into two parts. In the first part, I'll just go over the technique again. I've made other videos showing the same technique, but it can't hurt to be too redundant. And I'll try to make this as comprehensive as possible, which might take a little bit of time. And so I decided to divide it into two videos. And the second video, I'll show the live trading of this exact chart and this technique. This particular chart is from November 19th, which is today, or yesterday. And it was a particularly interesting market because it showed all the basic formations that I'm trading using this technique. And it was a very symmetrical day. There weren't there weren't too many surprises, but even on days where it's fairly random, this technique will still work. And when I start a day, I've got all my points. If you see all these horizontal lines, the software of this particular charting package for this broker has a setting where these grid units will adjust automatically. But I have them set fixed on one point so that when the market becomes more volatile, as these price bars get longer, I'll see it in an instant because it'll be indicated by the grid units becoming closer together. And when it really becomes volatile, they can actually be so close together that it makes the chart look gray. So I would say today was a day of moderate volatility. The price bars are moving, maybe an average of 4 points. If you averaged all the bars together, you'll get some longer bars, but this is probably pretty much an average day, with the exception that it's got a fairly good trend here starting out. And so I'll just go through this particular market to the time of 8:30 is where I have it analyzed, and hopefully I can show the trading for the first 2 hours, but I'll try to make it quick by speeding it up in the live section of this. On the second video I'll do a live trading version from a market replay program, but it will show how the actual market looked in live trade. And hopefully I'll try to show 2 hours of that, and where I can I'll just speed it up with that market replay program to save time. But to be really basic, I know a lot of people might be new to trading, and basically charts are plotted with the open, high, low, and close prices for the period of time you're plotting. And typically a chart would be either a bar chart, but today it's become very popular to use the candlestick charts, and they use the same data, the open, high, low, and close. It's just that they're plotted in a more colorful way. I still use the older bar charts just because these are more accurate as far as my method is concerned, because I can see the exact area where they're crossing the crossover points, and I spot the swing formations a little easier using bar charts. But I realize a lot of people, the modern trend is to use the candlestick charts, I think mainly because they're colorful and people like the colors of the candlesticks. This particular candle is showing a low that's lower than the open of this particular time period. So the body of those candles are colored in red, and if the close were higher than the open, it would be a green body of the candle, and these would be called the wicks, and the body of the candle is colored in. I just like a plain old open, high, low, close bar chart, because it just shows my formations a lot better that I'm trying to plot here. And what I'm doing with a set of, let's see here, where did okay, what I'm doing here is, if we had behind every chart there's a stream of data, and for example this would have the open, low, the high, low, open, close data, and this is what is used to plot a bar chart on a bar graph on a chart. And what I'm actually doing is an old technique called ringing highs and lows. And so the older traders, before the advent of charting services, would make their own swing charts, and they take the high columns and the low columns of the open, low, or the high, low, open, close information for the day, and accumulate columns of highs and lows, mainly is what they're concerned with, and you do a series of ringing highs and lows is what this technique is called. And so they'd ring the high in the high column, they'd ring the high that is higher than the previous high and higher than the high that follows, and you do that through the high column, so you get these rings here. And the low column, you would do the opposite, which is ringing the low that is lower than the previous low and the low that follows, and you do that for the low columns. And I'll show that over here, what that looks like if you were to plot it on a chart. You would get all these I placed an orange circle over the what that looks like on a chart. These minor, they're called minor highs and low points, and you can see that here that this low would be lower than the previous low, and the low that followed, this high would be higher than the previous high and the high that follows. And so above each of these I place a dot, and these would be the minor swing points. And here's a definition I put up here. I'm also demonstrating this in writing on a forum, and it helps if people can just read a definition rather than having it explained. But basically it's what I said: a definition of minor swing points, a high that is higher than the previous high and higher than the high that follows, a low that is lower than the previous low and the low that follows. And this would be an example, just to save space, I did it on the same bar, what it would look like if it was graphically plotted on a chart. And most of the time this is going to be, the high and the low are going to be two separate price bars, but you can get some that occur on the same bar. But for the sake of space, I just showed the example here of a low that's lower than the previous low and the low that follows, and a high that's higher than the previous high and the high that follows, and those would be the minor swing points. So that's what I'm plotting here on this chart. Now if we connect them by lines, I just drew the red lines would be for the downswings and the green lines for the upswings. You can see that this is in a downtrend. So in this case, the downswings would be considered the action swings. Action swings are always the swings that are longer in the direction of the trend. And then you'll have a reaction swing, and then you'll have other action swings continuing the direction of the trend, in the trend direction. And these are the ones we want to trade. And we want to trade the action swings and ignore the reaction swings. So the goal is to get into the market to avoid the reaction swing and get in the trade just as the you want to avoid the reaction swing and get in the trade just as the action swing is resuming in the trend direction. And in this case, the indicator, which is the blue line, that's the ADMA line, is below the magenta colored 14 simple moving average line. So the ADMA would be the exponential moving average, and it's 8 period, which I find works well to contain the trend. And the 14 simple moving average, 14 period simple moving average, is what these this Bollinger Band indicator is based off of. So this would be the center line of the Bollinger Band indicator, which is also critical to my trading because it envelops the market. And I'll show you how I use that indicator as well. But basically, what I'm trying to show here first is this basic minor swing structure to the market, and that's what you're trying to see mentally. Obviously, when you're day trading, you're not going to see all these lines drawn in, but I'm just showing this to illustrate what I'm actually seeing mentally as I'm trading. So in your mind's eye. And this is the basic market swing model that we're trying to get to by plotting the swings here. And usually you'll have, let's say this is the uptrend, you'll start off with a 1, 2, 3 pattern. Very common in trading. That's usually the first thing that a trader in technical analysis will learn is the 1, 2, 3 bottom or 1, 2, 3 low, and then you'll have a 1, 2, 3 at the top of the trend. You'll have a 1, 2, 3 top, or it's also called 1, 2, 3 high, going in the other direction there. And it's important that the number 1 point be lower than the number 3 point in the 1, 2, 3 bottom, and the number 1 point be higher than the number 3 point in a 1, 2, 3 top. And in between these trend change formations, the 1, 2, 3 tops and bottoms, you'll have a series of what a lot of people call hook type swings, and people have also called it another popular term is fractals. So they've been called fractals. I've usually just called them hooks. And so you could actually label them just the same way but to distinguish between the 1, 2, 3 tops and bottoms, I just label them hooks. But you could also number them 1, 2, 3, and so this would be the P3 point. I just call it P3 point. P meaning the minor swings. And if I were looking at intermediate swings, I would call it the I3 point. But so this would be the 1, 2, 3 point in a hook. And once you start a new hook, you start the same set of numbers. So what was your old number 3 point becomes your new number 1 point in the new hook direction as we move up. I've only shown one here in this model, but generally you can have three and more hooks, and that's typical within a trend. I say 3, but often there's much more than that if the trend is very strong. But typically you're going to have a minimum of 3 3 hook patterns in a trend. And so you hit the trend change formation on the top, and you get a 1, 2, 3 going in the opposite direction, and you start the same patterns downward in the downtrend. And basically what you want to do is, the reason for identifying these swings in the first place is because we're trying to capitalize on this pattern as a way to enter a trade. And in this case, this model would be in an up trend. So you've got a P1 point, a P2, then a P3 point. And so this would be the reaction swing. This would be the action swing in the direction of the trend. And so the idea is you want to catch the action swing in the direction of the trend. And I use a point 25% into the new swing to show that it has momentum before entering the trade. And so this, at a 25% point, this would confirm the P3 point as being valid at the same time. So when you hit that 25% point, that would be your entry signal, or your entry into the trade, a time to be a buyer, to go long. And at the same time you enter the trade, it would also confirm the P3 point as being valid. And so if you want to do the mathematical calculation, because the markets are symmetrical, you could say that the distance from P1 to P2, take 25% of that and then add it to P3, and that would give you your entry point. And that's what I've done here in this equation here. And for the target, and under the assumption that that's also a symmetrical target, because history tends to repeat, and the immediate future represents the immediate past in trading, which that's the whole reason why trading is possible, is because these patterns are repetitive. We assume a symmetry for the model, and so P1 to P2, the distance here, will probably be the equivalent distance here. So we'd say the projected target to P4, this point here, would be P2 plus P3, take away P1. Or essentially you could do this the other way, saying P2 take away P1 plus P3. They're the same equation. It's easier to write it like this because this gives you an exact numerical point to enter. But the point is, in day trading, you don't have time to do this math, so we need I use indicators as tools to tell me these points of entry, which I'll show here. So now that we've got our minor swings calculated, you can see these entry points approximately where they would be entering a trade. Not exactly 25% of the last swing, but close enough. And you notice where they fall is right on this ADMA line. So the closer you get to that ADMA line on your entry, which is why I use this indicator, that's going to get me into the swing in the new trend direction, or the new action swing. And you can see almost in every case, if you just enter right on that ADMA line, or as close as possible to it, you're going to maximize each little trade. So in this case, I'm showing 1, 2, 3, 4, 5, 6, 7, 8 trades in this one downtrend. And almost all these trades, I think, are 5-point trades, which are each $100. So yeah, you're looking at for a half an hour, 9 minutes of trading. So yeah, $800 worth of just doing this simple technique is worth $800 per contract. So if you were trading more than one contract, you just multiply that by the number of contracts you're trading, and you can see how lucrative it can be. So the thing you want to be conscious of is that there's also a intermediate swings happening on top of the minor swings, and you want to the highest odd trades are going to be to have your minor action swings in the same direction as your intermediate action swings, and I'll show you what I mean by that. So let's plot the intermediate points, which I've marked in purple here. And what an intermediate point is a minor point that's lower. In the case of an intermediate low point, it's a minor point that's lower. This would be a phantom point right here, but I'll get into talking about what phantom minor points are. But let's take this minor high that's higher than the previous minor high, and the minor high that follows is an intermediate high, and we get one over here at the starting of the day. And if there's no minor low that meets that same definition of being, notice this minor low is not, it's lower than the previous low, but it's not lower than the low that follows. So this would be if you run into that situation, you just take the lowest low between the two intermediate highs, and that'll give you the swing down, or the swing into the action swing intermediate swing direction. Where in this case would be considered a phantom point, because it doesn't meet the standard definition. Now this intermediate point on the bottom is lower than the previous minor low and the one that follows, but in either case they're valid intermediate swings, as I'll show here when I connect them. I connect it by the orange line. That shows the intermediate swing direction, and again, this is something you're seeing in your head. You're not obviously you're not having time to mark these charts, but you're basically trading the minor swing directions that are aligned with the intermediate action swing, and you're trying not to trade the reaction swing at the intermediate level, and that keeps you out of a lot of trouble here. Now this is a trending day. Some days when the market's more sideways, you can these reaction swings on these intermediate swings are more lucrative, but because it's in a trend, you generally you're going to have really good odds just sticking to trading the intermediates or the minor swings that are aligned with the intermediate swings, and preferably the minor action swings that are aligned with the intermediate action swings, and avoid the reaction swing. And that's a lot of knowledge going into trading, where you're just stacking the odds in your favor, and that's all it's really about. You're just trying to really so you're not gambling, you're stacking the odds about 90% that it's going to move in your intended direction after you enter the trade, if you follow all these guidelines. So you're not trading the reaction swing, you're trading the action swing that's in the direction of the intermediate action swing. You're entering the trade on the ADMA line, which, as you can see, contains the trend. I'll get some of those things off the chart so it's easier to see it. So you can see how well this ADMA line, exponential moving average, 8-period exponential moving average, it really contains the trends well. So most of the time, even if you enter a trade that's not timed too well, and you get a little bit of movement opposite your entry point, that's not really a problem because I have my stop losses set at 5 points. So as long as you're entering on that ADMA line or as close as possible to it, your odds of success are pretty huge because this line contains that trend all the way down. It does the same thing for the uptrend, only in the case of a downtrend it's containing the highs of these price bars, and an uptrend it would contain the lows, and it just works as a beautiful trend line here. And so the point at where they cross over, the ADMA crosses over the Bollinger Band 14 simple moving average center line, the point where it crosses over is usually a trend change. But it can fool you and pretend like it's going to cross over in the downtrend. That's why be very cautious of taking one of my entry signals is the crossover here, but in a fairly strong downtrend you want to just stick with the trend direction and not take the crossover trades, or be very cautious when they do crossover and look for more development before assuming that the trend has changed. And at certain periods it'll try to fool you here, but you can see what this really is a oops, I just deleted something there. What this area that could deceive you a little bit is really a intermediate reaction swing. So if you're aware of this intermediate structure and you don't want to trade those reaction swings anyway, you're not going to be deceived by assuming that's a trend change. Now down here it's a trend change, but I don't automatically assume it is until we get a fairly large move, and then I'll show on the next charts where you would look to enter that in the next trend, and you're looking for basically a 1, 2, 3 pattern here to signify a new trend. So you're looking for the 1, 2, 3 in combination with a crossover signal. So there's a lot of signals that you can go by, and I'll show okay, here's the intermediate swing point definition. An intermediate high point is a minor high that's higher than the previous minor high, and the minor high that follows, which I've marked in purple. Intermediate low point is a minor low that's lower than the previous minor low, and the minor low that follows, which I've marked in purple here to give you an example. And these would be the minor swings in orange, and so we can see how I'm determining where this intermediate price structure is. Basically, what I'm showing here is how my indicators are working, and fundamentally it's a sine wave pattern for the ADMA indicator that moves over the 14 simple moving average indicator as if this were the zero baseline. And so we're kind of trading two sine waves that are slightly out of phase, and we're interested in the crossover points, and we're interested in the slope of the ADMA line as it's moving in towards the simple moving average line, the 14 simple moving average, the magenta line. You can see that we'd want to be a short trader in this cycle of the sine wave, and because it's moving up here, be a long trader. And I even am more careful than just trading when it's moving up. I want to see the crossover occur first, then I'll take a long trade. But as it starts to bend inward, I'm aware that a short trade is coming up. So always be aware of these sine wave cycles, and you can kind of see it. You can kind of see it here. Well, that's probably not the best example because we're looking at a strong downtrend here. But this ADMA line is moving in a wave fashion, As it starts to bend inward here at the bottom, you can see to be aware that it's about to cross over, and you don't want to be a long trader as it's starting to bend inward. I mean a short trader. You want to be get ready to go long. And likewise here, it starts to bend inward. You don't want to be. You want to wait for that cycle to pass by. Wait for it to start bending outward again from the 14 SMA line to be a short trader. So you're always aware of this, what this ADMA line is doing relative to the 14 SMA line. That's how my particular use of these indicators works. And as far as I know, it's fairly unique system. I don't know of anybody using these two indicators quite like this, but there might be others out there. I just am unaware of it. But I'm using it. I do know it's kind of unique to use these indicators in combination with an understanding of the basic price structure here on where to enter the trades. And so this, in my opinion, it's the best method you can use for trading. You're going to have so much information about where the market's moving that there really is no speculation or guessing. You're just following what it's telling you to do. So it's actually speaking a language to you. Like all these points where I've marked to go short, it's just basically telling you that's where you take the trade if you speak the language. And so that's what I'm trying to show here, is what the language is. So that's the relationship of my indicators that I'm using, and kind of drawn a crude diagram of how they look in reality. In reality, there's not, the SMA isn't just flat like that zero sine wave line. It's more of a DNA kind of helix faction. What's the word I'm looking for? Well, they make elliptical patterns, and they cross over in kind of like the helix of a DNA strand. And at these crossover points, for example, if the ADMA is moving inward, you're getting ready to go long. At the crossover, you go long here, which I've marked with a green line for the long entry, which is to buy first. And you'd sell at some point up here when you had a profit. Then you'd, as the ADMA line is coming inward towards the 14 SMA line, that's a sell signal as it crosses over here, so you'd go short here. So that's a basic concept behind how those indicators are working. But they're only there as tools to complement the basic price structure, so you've got to use that in that context. So what I'm showing here is all the points that I'm plotting on this actual chart. This is from November 4th. I've shown this chart before, but these are the actual prices that are underlying all these, where all these bars are plotted. And this shows, let's see, about 7:03 is the last data that I've got here, and the market opens at 6:30. So we've got about 32 minutes of data, and so on the chart, 32 minutes would be about right here, right in the center here. And I just completed out the rest of the chart. But what I'm showing here is how the old guys, the old timers, they would create their own swing charts. But today we can just look at the chart basically and see it visually, which is what you want to do anyway for day trading. I'm just showing the concept on how these points would be determined. But you can visually see it here and just plot the minor points where the high is higher than the previous high and higher than the following high, and do the same with the lows, and you get these points, and then you connect them together and you get your minor swing points. And that'll give us the areas where to enter trades. This area, for example, would be an uptrend section. As you can see, in comparison with the market I showed for today, which was in a fairly good steady downtrend, this market is, by comparison, moving sideways. So you've got a little bit of both. You've got downtrends, you've got uptrends, and when the market's like this, the crossover signals work very well in both directions. And so that's just a caveat to when some things are more effective than others. So you're always looking at these different signs, different types of markets. You're gauging the volatility. And let's take this uptrend section here. We'd want to enter the trade here at the ADMA line on a buy order, as the ADMA line is angling outward from the 14 SMA line. And some people have compared this to an alligator mouth opening. And you want that, so slope is very important as a signal. Just like I was explaining in the sine wave cycle, this will be the upward cycle of the sine wave. So you want to be a buyer, and that's above the magenta colored 14 SMA line, so that tells you what side of the market you want to be on. So that's a very helpful tool there. You always want to trade the side of the market the ADMA indicator's on. So in this case, it's on the upside of the 14 SMA line, so we want to be a buyer as it's angling outward. And we've got the 1, 2, 3 formation here, and we're taking the trade as it resumes the action swing into the trend direction. So we've got all that information on where to enter this trade, so there's no surprises here. On this side, we see the ADMA start to angle inward, and we're waiting for the new number 3 point in the trend to form, but at some point it's fallen halfway the distance of the previous uptrend. And so we're seeing all these crossover signals. We're seeing the ADMA angle inward. We're seeing it move towards a crossover point. All these signals tell us we don't want to be a long trader. So we're safe. If we're watching all the signals, we're not going to make a mistake and try to go long as the market's falling against us. If we're really watching our indicators here, and that keeps us safe, so it keeps us on trading the right side of the market. So at the crossover point, normally using this swing model system, you'd have to wait for the new swing and the new trend direction before you could take a trade. But part of my signal takes advantage of the cycles crossing over, and you can actually take a short trade at the crossover point. But just be aware that you want to see it. You want to see the price bars really cross over this 14 SMA line with a lot of thrust first, and then you take the trade on the other side. Just make sure you have the crossover occur first, and it's definite. And so we get a reaction swing in the new trend direction. Now we've got a 1, 2, 3 in the new trend direction, and so we take the short trade, and we've got the ADMA on the bottom side of the 14 SMA line now, so we take the trade in the short direction. So we got all that information, and we're not going to be wrong on direction there either. So we're waiting for the P3 point to form, and then we take the trade. The P3 point forms, and then we take the trade, and just repeat that process for each trend cycle. Often you'll come into periods of consolidation where it's not really trending, it's not really trending one way or the other, and that's when the market gets flat. And you can tell that by these Bollinger Band lines will start to move sideways, or and in this case they're starting to constrict, which tells you down here you don't want to be a short trader anymore, because the ADMA is starting to move inward. So this is kind of a no trade zone, and you wouldn't want to be a trader again until you got the crossover, and then you're looking at a expanding Bollinger Band lines, and now you're trading in the new direction. And so then your signals start working again, your swing lines. You can start trading the swing signals. But there's going to be periods of consolidation like this. Some people call them congestion areas, or what they really are tight trading ranges, which are kind of like areas you don't want to be a trader. And so on top of these minor swings, I drew the intermediate swing lines, and then I connected those, and I get a really busy chart. And so this is just, again, being aware of where the intermediate swings are occurring keeps you trading on the right side of the market, because you want to trade the minor swings, minor action swings that are going in the same direction as the intermediate action swings. So if you're aware of the intermediate level structure on top of the minor structure, and I know it's really busy, it's hard to tell what's going on here with all these lines, but this is just what you're aware of in your mind as you're trading. And so I've just isolated the intermediate points here, and just to clean it up a little bit, I just showed the intermediate swings. And so you can actually trade these like the minor swings, just on a larger scale. And so you can see here would be the first intermediate swing in the new trend direction, going from an uptrend to a downtrend, and you trade the crossover points of the 1 minute ADMA and 14 SMA line on the 1 minute chart. And here's the retracement swing, so you don't want to trade that. You wait for the P3, in this case it would be the I3 point to form. So you get the 1, 2, 3, and I3 meaning the intermediate number 3 point. And you could trade at the crossover here at the ADMA line again. And so you can trade on the intermediate level if you're aware of that, what it's doing on this level. So I'd be a short trader here, and I'm using the target from here to here. From the P3 point would be the new target P4 right here. So that gives you a really good estimation on where to set your targets, how much you can expect a move to make. And same thing here, you get a fairly symmetrical reaction swing that's comparable to the last one, and you enter the trade as it moves back into the reaction swing direction of about 25% of the last swing down. So 25% here would be right around this ADMA line, which is why I use the ADMA line as a good gauge for as the market moves back down. And I'm waiting for that ADMA to angle outward from the 14 SMA line. You know, see here it's moving kind of flat. In reality, when it's flat like that, I'm not taking the trade. I'm waiting for the movement, the ADMA line to move back down and away from the 14 SMA line. Then I'll get in the trade probably a little bit late, right about here. And I just want all these things lining up before I can take the trade. And I've got just a huge amount of information telling me what the market's doing. So they're just, if you're aware of all these signals, there's never any surprises, very rarely. There might be an occasional strange event that happens in the news that causes an anomaly, but the vast majority of the time the market's really telling you what it's doing. And here's how I enter the trades. I've got the software sets up my trades in what are called bracket trades, which means at the entry point it's bounded by two orders on either side of that. We've got the sell limit order on a, if I'm long, if I've got a buy bracket, So I buy here and enter the market, and the moment I buy, the software will set up a target. That's not mandatory. You can trade with or without a target. Sometimes I'll drop the target altogether and just use a trailing stop loss trade. But I recommend always trading with a stop loss order, because that's your insurance policy. So if I'm long here and I buy here, this distance to the target is my profit zone. But if the market were to come against me and hit my sell stop, that's my loss. But the reason for setting the sell stop is because you want to limit your loss. You don't want to have an unlimited amount that can move against you. So always trade with a stop order. And so that initial setting is automated by the trading software when you set up a buy and sell brackets. And so this would be considered bracket trading. And same thing with the sell bracket. If I'm short here, my corresponding, instead of a sell stop to get me out of a long trade, I would need a buy stop. You always need the opposite of what got you into the trade. So I'm short here. So in order to get out of the trade, if the trade came against me, I would need a buy stop. You've always got to do the equal and opposite action that got you into the trade. So I sell here and go short. And if the market came against me, I'd buy to get out of it with a predetermined loss, so that these stop losses act as my insurance policy. So I always trade with those. And the buy is my profit target. And usually the target orders are limit orders, because they're set. It's just the way the limited and stop orders work. For a stop order to be triggered, it has to be. It's usually triggered on momentum. The trade is moving in the direction for the stop order to be triggered. But since we're long here, and we're beneath the hard to explain. It's easier to explain if I talk about the long. The sell limit order would be the market would have to trade. It's set above the market, the current market price. So the market would have to trade into it and beyond it to trigger the limit order, then back through it. But a sell stop is different in that the minute the market would trade to the sell stop, becomes activated and becomes a market order on if touched. Now you can set the limit orders to get you out if touched. You'd have to set a MIT order or market if touched. That gets into the kind of weeds there. I don't want to make things too confusing, but basically the stop orders guarantee execution, just not at the price you want. So there can be some what they call slippage with stop orders. The limit orders guarantee your price or better, but they don't guarantee execution. That's the difference. So it's critical that you get out on the stop orders, not so much on the target, because you're watching those anyway, and if it doesn't get you out, you can always get out manually. So the targets aren't that critical to set, but the stop orders are always trade with the stop orders. So let's go back to what today's market did. What I'll do here is I'll show what my buy and sell points are, and then in another video I'll show actually trading this market using this exact method and where these buy and sell points occur. And so I plot the minor points, which I'm doing in my head as I'm trading. So as the market opens, it immediately proceeds downward. On today's market, I went short on the first minute after it moved downward. What I recommend for new traders is wait for the fractal or hook formation to form first, and then trade at the 80 MA line. So your short trade would be here, right at the approximately where the open is, even with the last close. So I'd like to enter right on the open of the next bar after the previous close, as long as it's close to the 80 MA line. So a lot of times you'll see me mark the order entries right at the open of the new bar. And so we assume the P3 points made here, and at the point of entry, the 80 MA line is moving downward. In this case, it's kind of angling inward. If this were a flat sideways market, I would be very cautious if it angles inward, but just because of experience, and I knew that this is trending fairly strongly, I entered the trade here. I knew it wasn't likely to reverse easily, so that was a good trade there. And well, I'll just show the process here again. So yeah, connecting these swings, these would be the minor swing entry points. Here's where I actually enter the trades with these red entry points, and here's where it faked crossover, but I'm aware of the intermediate price structure, so that didn't fool me. And I'm also aware that it's constricting here, and I didn't have much room to the inside. The Bollinger Bands are, as you see, when they're constricting like that, you don't want to trade when they're narrowing. The time to be a trader is when they start widening out again. Constricting shows decreasing volatility, and when they're widening out, that's an increase in volatility. As they move back into the trend direction, you can see the widening out of the Bollinger Bands. John Bollinger is a great has one of the greatest indicators. The Bollinger Band, I think, is one of the most useful indicators, which is why I use it next to the 80 MA line. And you can see I'm entering on the 80 MA line here after the fake out back into the action swing direction. In this case, it would be the intermediate action swing downward, just as it resumes downward. And look how strongly it moves into the new intermediate action swing, and which always make great trades. And the 80 MA line is coming outward. So I'm just plotting the intermediate points here, as I did before, and just showing where that intermediate line is. If you haven't already seen it, this is what you're seeing in your mind. So you're always keeping aware of what that intermediate level swings are doing. And so if you can enter the intermediate direction action on the action swing as it's resuming the trend direction, you're usually going to get a really good trade right there. But what I'm showing here is just at the point it started to change trend direction, and notice how flat when the Bollinger Bands start moving upward, kind of like a spoon formation, and the trend itself is shallowing out. It's forming kind of a spoon shape. That's kind of a red flag for me. It's also an older trend, so it's moved down quite a ways, quite a few swings. So I was expecting a trend change would be imminent, and sure enough, right after the 7 o'clock hour, 11 minutes, it changed trend direction right where I've marked that arrow. Now, if you've already accumulated a few profits, you might feel a little bit risky and say, well, I think I'll take a long trade. Right after this thrust upward through the 14 SMA line, this bar thrust upward first, and then if I'm feeling a little bit risky, I might take the trend change in the new trend direction. But if you want to be a little bit more conservative, you can wait for the here's a continuation of that chart. The scale changed, but This is right here at 711, where we were on the last chart. And I'm just showing that it's a little bit of a different scale because I advanced the chart forward. So you can see it's getting less and less volatile by how far my set grid lines are set at a point, and by how far they are apart, you can tell volatility at a glance. And you could see you could take this long trade right here after the crossover, but if you want to be a little bit more conservative, you wait for that new trend to establish. And because we haven't had a 1-2-3 pattern yet, we get our 1-2-3 pattern after the crossover. Sometimes you can get it before the crossover, get it during the crossover, or get it after. And we haven't had it yet, so I'd be very cautious about taking that trade. But once the trend's established, a really conservative continuation of the trend here. We've got the ADMA angling outward again, and so we know we're in a uptrend and make a good trade right there. Again, I'm plotting the minor points. This is all, by the way, this is the November 19th chart, so it's fairly recent. Some of these points you'll notice I marked in red, and those are the phantom points. In this case, let's say between these two phantom or two minor high, there isn't a corresponding minor low that's lower than the previous low and lower than the following low. So between these two minor highs, we just take the lowest point between these two highs, which gives us our phantom point. As you can see, it's an ascending highs on the bottom, so it doesn't really meet the qualification for a minor low, because this low is lower, but it becomes a phantom low because we've got two qualified minor highs right here, and so we take the lowest low that occurs between these two minor highs, and that becomes a phantom swing. We can do that on the same thing with intermediate swing points, and so that's why I marked that in red. And here would be just drawing in the minor swings. We can see as the market gets flat, as the Bollinger Bands get flat, and the market gets confused, it's almost making swings upward as large as the swings downward, so the trend direction becomes really confused. We always want to see if this were the number 1 point in this particular swing, and number 2 point, we want to see the 1 point be higher than the number 3 point to take a trade in the down direction, with the qualification that the ADMA line is on the bottom side of the 14 SMA line to qualify trade directions. I'll just show the entry points here. Well, I'm showing the intermediate points right there, and connecting the intermediate points. And as this was occurring, because I was aware of the intermediate price structure, and I know that intermediate points are usually found in congestion areas, I was aware of what the market was about to do. I saw that it was making the intermediate high was made here, you had an intermediate low here. I was looking for a number 3 point here, and that told me that was a 1-2-3 top pattern, and it was about to move break out below this support area of this congestion area. So I was alerted well in advance to get ready to go short at the breakout of this support, as I'll show here. Just a beautiful trade right there. You can take breakouts of support and resistance, and that's another one of my major signals. And I'm taking away all the clutter here just to show you where those entry prices. This is where I actually did go along after the crossover, but that's a more risky trade. But just based on experience, I saw that it was probably gonna change direction at that last crossover just because of the trend was so long in the tooth, and you could see it rounding and getting ready to. You just kind of develop a sense when they're about to trend change. So at that crossover trade is when I went long and got a good, I think it was a 5-point trade out of that. And then this would be the more conservative trade, taking the continuation of the trend right here, this second trade. So even if you miss a few, you don't want to take the risk. You don't have to take every trend. You can just wait for the hook to form first and then trade at the ADMA line. Usually if the entries and closes are formed off the ADMA line some distance, I want to make sure that the tail, if this were a candlestick, this would be the wick. I want to make sure it comes back, touches the ADMA, then comes back with momentum through the previous close. So that's when I'm actually not just jumping on that trade. I'm waiting for it to come back against the ADMA, and then coming back through the previous close, and then I'm a buyer here. As we reach the top, the number one intermediate point, you don't know that that's the number one point yet, but a lot of the signals that it's about ready to reverse is that you've got a good thrust upward here, and these bars are closer to the upper Bollinger Band, and you'll see that there's some distance here from this low that makes this number one point. This low here where I've drawn the red dots is some distance from the ADMA line. You compare that with other lows in the trend. As you're emerging the trend, they're almost right on the ADMA line. But as the trend gets older, gets ready for a reversal, it starts to hug the upper Bollinger Band. It does the same thing with the lower Bollinger Band in a downtrend as it gets ready for a reversal. And you can see as it breaks below the low of this previous bar, it drops some distance to the ADMA line. In that case, my rule of thumb is, at the same time also I should note that the Bollinger Band is starting to bend over. And so my rule of thumb is I want to see it trade below the ADMA line and then back up through it before I can go long again. But by the time I see it's crossing over the ADMA line, that ADMA line is bending inward, which is a signal it's about ready to change directions. And we get a thrust through the 14 SMA line. That's a sign you really expect a change in direction. You really want to be short. But I'm also aware that if this is a number 2 3 point, I want to wait for the number 3 point form. So I don't immediately go short here. So I wait for this 1 2 3 structure to form first, and then I wait for a move back through the ADMA line. And there I'm in a trade direction. And this is kind of a risky trade, but because I'm looking at the Bollinger Band here, this will give me the distance I can kind of expect out of a trade. So I've only got 2 points here, and often I won't take those first breakthroughs, but in this case I had a lot of profit stored up, so I didn't mind taking chances at this point. And I'm also locking in my profit as I'm going, but this didn't quite hit a 5-point target, I don't think. 1 2 as I remember it trading this morning or yesterday morning, I don't think I hit a 5-point target. I just locked in my profit, and I made one more. Then I decided it was moving too much sideways to keep trading in this range. Anytime it starts to go sideways, and the ADMA line starts to go flat, and the 14 SMA line, they start running parallel and laying on top of each other, and the Bollinger Bands are starting to go flat, I recognize that I'm in a tight trading range, and it's probably not worth it to try to trade each swing in direction. Just wait for the breakout of these. And so what I am looking for in a tight trading range, I'm looking for this intermediate price points. So we've got the number 1 point here. We've got two minor swings down, and then we get what I'm already seeing as number 3 point. We get the congestion area, so I know not to trade in this area. It's moving flat and sideways. And we've got a qualification already at this point of this intermediate low. So I already know the structure has formed up because I'm aware of what the intermediate level swings are doing. And then we get in the middle of this flat area, this congestion, sideways congestion, we get a intermediate high point because we've got two minor swings on each side of that. So at this point I'm alerted that, hey, this is not only is this resistance, but we've got a 1, 2, 3 swing, intermediate swing, and so I'm going to trade the breakout below support here, and that's exactly what happened. So had all this information going into this breakout, and just to review, so you see it visually, what I'm seeing in my mind. You see by this orange line where this intermediate 1, 2, 3 high is, and so I'm seeing where it's bounded by support. Support is where all these lows are kind of accumulating. I should have drawn the line a little bit higher, but it's in that general vicinity there. Usually support is in the where the Bollinger Band is. The lower Bollinger Band is moving flat and sideways, and same thing with resistance on the top here. And you can see here's a continuation of this chart. So that's a break below support. Here's that break right here, and we get a huge downswing here. And on these types of breakout trades, a lot of times I'll just use a trailing stop. I'll just drop the 5-point target altogether. And so I've got about an entry here where I broke through support, and then another entry here as we get a minor P3 point, a retracement swing, and then I enter in the new action swing direction with a target trade. So I get about a 5-point profit here, and because I was doing a trailing stop trade here, that may be a 10-point profit there. Each point is worth $20 per contract, so you know, a good 20 point trade in, say, 5 minutes or so, 5 or 6 minutes. That's a good $200. So $100 for 3 minutes of work is not bad. Same thing here. You get another $100 for 2 minutes of trading, just following simple signals that are very obvious to me, that anyone can be trained to see them, using these indicators and using the combination of understanding what the market structure is doing. We get a crossover here, and anytime I see the Bollinger Bands coming down, they're really constricting into a trend change. I'm very aware that I might not get my full target if I were to take a crossover trade. So as you can see, I don't show an immediate desire to go long there. I wait till I get the number 3 pattern, the 1, 2, 3, and wait for the new number 3 pattern. Right here, it's still kind of flat. I decide to go long and kind of chance it. You know, I don't know if we're out of the congestion area here or not. Could be another trading range, but it's flat. It's not really moving inward towards the SMA line, so I took a trade right here, and that's good for maybe. I think it came back against me. I got about a point of profit out of that, but where I started to get back into the trade is it starts moving into the new trend. And ideally, probably where I show here, that's probably not the best point to enter the new trend either, because you're not sure if the sideways movement is over yet. If it keeps moving sideways, the likely for it's in a kind of a trading range, and the most likely thing to happen would be to cross over and go to the other side of the range. So you really want to make sure that new trend is starting, and so probably a better entry point would have been right about here at 8:17 or 8:16 in the morning. Here's the timeline here. So 8:16 in the morning at about 8:326. Make an entry here, and then you get a good 5-point trade, and get a couple of those in this uptrend. This is an example of how the volatility can be getting lower, but the trend remains intact. So these are low volatility bar moves, but we've got a good trend, so those still make good trades, even though the volatility is somewhat lower. So there are different ways you can look at volatility. You can look at the steepness of the trend, or you can look at the range of the price bars. But I'll just show where these minor formations, if you haven't already guessed, that's what you should start to do, is start seeing them automatically. And I've colored in the phantom minor points with red, and here I'm showing the entry points for the trade. So we get about, in this particular time frame, a little less than an hour, we've got 1, 2, 3, 4, 5 good trades. And here are all the minor points. As you'll see, the intermediate points become very important, because sometimes you determine where the phantom points become very important for determining sometimes where the intermediate points are. And if you draw the intermediate level points here, you see how that price structure is forming at the intermediate level. And if these intermediate swings are kind of hard to see, what I do is I trade side by side with a 5-minute chart, and the 5-minute kind of shows me at a glance what the intermediate swings are doing. So that makes it a lot easier, and I'll show that in the live trading, or the trading of the replay of the actual market. And obviously this video is running kind of long, so I'll make a trading video of these exact charts and show you exactly what I'm showing you here, only the way it would look in a live market. And so that'll be my next video, and I'll just kind of leave it off for here, because I think we've already gone fairly long. So have a good one.